I'm really delighted to introduce Simon Chu, who's over at Harvard Business School. Simon has been working at kind of the interface of finance, accounting, financial reporting, and regulation in the broad ESG space, particularly on the regulation side and market effects. He and I have worked together. We have one particular project doing some textual analysis. And so Simon is really well versed in applying really higher level approaches to measuring different types of corporate exposures to environmental concerns and risks. And so Simon today is going to be talking about a couple of different things. It's an integration of a couple of papers and areas, a theme that he's working on. And I'm going to let Simon do the magic because he'll explain it better than I can. Simon, it's a delight to have you here. Thank you for coming.
Thank you so much, Eddie, for the introduction. Super excited today to share an ongoing series of projects and papers, broadly titled Environmental Regulation, Pollution, and Economic Outcomes in Capital Markets. All right, so let me get straight to the motivation. We know that environmental risk matters, right? Institutional investors really care about environmental risk. They engage in these risks in their investment portfolios. Here are just some headlines to kind of illustrate the growing importance of this issue, right? Institutional investors are aware of the climate risk on their portfolios. These risks are immediate, in the short term, and they're also engaging in addressing these risks as well. Okay, so there are broadly two types of environmental risks. One is on physical risks, which is kind of like risks related to natural disasters, hurricanes, sea level rise, etc. This paper, or the series of papers, is going to focus on regulatory risk, right, which is kind of the transition risk side. Environmental regulatory risk is very important, right? In a survey article by Kruger et al., they survey a range of institutional investors. Regulatory risk is kind of ranked number one, and it's especially important over the short term, right? So another survey paper by Strober and Werdler, these risks are important over the next 5 to 10 years. Physical risks are important, but they're kind of more long-term, right? The next 40 to 50 years. Why these regulatory risks are important? Because they have financial and material effects on the firm's operating performance, right? Due to the compliance costs imposed on these firms, it's going to kind of adversely affect the firm's cash flows in the future. And the costs of these environmental regulations are significantly larger than other federal regulations, those by OSHA or FDA. So kind of given this importance about environmental regulations, we actually know quite little about how do we even measure firms' exposure to regulatory risk. The literature has kind of looked at this from various aspects. For example, the literature has looked at global climate policies like the Paris Agreement, but there's always kind of this enforceability concern with global climate policies, not just at the firm level, but also at the facility level, right? It's kind of hard to ensure enforceability. Papers have also looked at carbon disclosure laws. These laws, they're nice, but the kind of link between these laws and firms' real effects is kind of, indirect. And importantly, these disclosure laws may not necessarily impose any binding emissions restrictions or compliance costs on these firms. So what this series of papers is going to do is I'm going to first introduce an institutional setting where it's quite exogenous. So the regulatory shock is quasi-exogenous, and it's going to impose binding compliance costs, right? Not just at the firm level, but at the facility level. And then I'm going to show you kind of the application of this measure that I create on various capital market outcomes, ranging from corporate governance all the way to institutional investors' portfolio allocation decisions. All right, so straight into the kind of institutional setting, I'm going to focus on the Clean Air Act and a special provision of the Clean Air Act known as the National Ambient Air Quality Standards, or NAAQS for short. Okay, so this is air pollution regulation on ozone precursors emitted by firms' polluting plants. And what these regulations are about is basically each year the EPA is going to designate every county in the US as either in compliance, known as attainment, or non-compliance, known as non-attainment. Okay? And how these compliance is determined is based on something called the NAAQS threshold. So the NAAQS threshold is a number that's set by the EPA. It has changed over time. I'm going to exploit that variation as well, but just assume this is a fixed number. And if the air monitors within a particular county measures the ozone concentration levels to be below that threshold, then the county is in compliance. If the concentration levels are above or exceed that threshold, the county is non-compliant. Okay, so this is quite straightforward. But what's important about these regulations is that they impose stringent binding compliance costs on these firms. So the environmental economics literature has studied these regulations extensively, mostly on the direct effects, health effects, compliance cost effects. So these regulations are federally enforced, right? If the states do not impose these regulations, they could be cut in terms of funding for highways, hospitals, etc. So there's real cost for non-compliance. And they have a material impact on a firm's emissions behavior. So firms have to change a lot of things, the way that they operate, new raw materials, the way that they construct their supply chains, all the way to investing in new machinery, new green technology, etc. All of this basically leads to an increase in the compliance costs for the firm's facilities, right? So basically, these non-attainment regulations are going to introduce this exogenous source of variation. I'm going to talk about this exogenating soon in terms of local regulatory stringency. And all of this combined is going to basically lead to an adverse cash flow shock for the firms that operate polluting plants in these counties. There is one concern that maybe firms kind of may gain this and they kind of strategically. I'll show that actually most of the impact comes from non-stationary sources like mobile vehicles, right? But the economic costs for the firms are large on the facilities. So it's actually very hard for facilities themselves to kind of influence this compliance status. The regulation is imposed on a yearly level, and the measurement of these concentration levels is done at the daily level. And what they basically do is they calculate a kind of like a rolling window across the past 3 years, basically. I'm going to exploit that as well. I'm going to actually mimic the way the EPA calculates the underlying concentration levels, and that's going to kind of feed into the empirical structure. Yeah, so more of that coming up. Okay, so let me kind of illustrate the type of variation that I'm going to use to study various capital market outcomes. So first, consider a county that is in attainment, right? It's compliant. And because the county is compliant, you could have heavy ozone polluters in that county. They're going to be unaffected by the regulation, right? Because the county is compliant. Okay, so that's kind of variation is extensive margin between compliance and non-compliant counties. Okay, but you could also have a county where it's non-compliant. You could still have a firm that is a heavy polluter, but it doesn't emit ozone in that county. It emits other chemicals, for example, such as particulate matter, sulfur, lead, etc. Because the regulation is for ozone, this firm, if it only emits particulate matter, it's also unaffected by the regulation. Okay, so there's going to be variation on the intensive margin depending on the amount of ozone emissions at the plants of these firms. I'm going to combine these two things together. So let me kind of talk about the overall big picture here, the roadmap, or how I construct this regulatory stringency measure. So first, I'm going to construct this firm year level exposure to these non-attainment regulations based on those two things that I just mentioned. First, I'm going to look at regulatory treatment at the facility level based on the type of chemicals the firm emits. Then I'm going to look at the kind of distribution of the facilities across the counties, such as attainment versus non-attainment. I'm going to basically combine those two things together, and that's going to give me this firm year measure of exposure. But there could be a potential problem here, right? And the most obvious problem is that maybe these counties just have a lot of local economic activity. And so there's going to be self-selection of where the firm locates its plants. And so this regulatory exposure could have this endogenous component that's determined by unobservable confounders. What I'm going to do is I'm going to use a regression discontinuity, right, design. This is the perfect setting for that, right? You have a threshold that defines compliance. You've got basically concentration levels slightly above, slightly below that threshold. It's going to give me a very nice setting to conduct a sharp RDD. And basically, I'm going to decompose that exposure into its endogenous or anticipated component and its exogenous, known as the unexpected component. Once I have that decomposition, I'm going to use standard, staggered, or stacked diff and diff to study various outcome variables. Okay? So threshold has changed 4 times throughout, not often. So there's a lot of variation. Some counties, so average non-attainment is about 16 years. It's pretty sticky. But some counties go in, so they don't go in and out in the sense that if a county is non-attainment and it goes back to attainment, it's very rare to see them go back into non-attainment. But the length of remaining in non-attainment varies. So those in like Southern California, is about like 6 years. In other places, it's about like 10, 16 years, etc. So there's a lot of variation across counties. Yeah. Okay, so onto the first step. How do I measure this firm level exposure? So the key database I'm going to use is the EPA's Toxic Release Inventory database, the TRI database. Now, this database tells us the type of chemicals, what chemicals a firm emits across its plants, but it doesn't tell us the type, okay? And it's very important to know the type because that determines regulatory treatment at the facility level. I don't know anything about chemistry, so I hire a chemistry PhD in atmospheric science to manually label about 650 chemicals over the sample period into whether they're ozone or not ozone. Okay, so I know the regulatory treatment at the facility level. So that's represented by this variable ozone. So it's the amount of ozone air emissions in pounds emitted by the facility. It's lagged by 1 year because that's the most recent observation from TRI database. It's always lagged by 1 year. And then it's going to be kind of this weighted sum across the firm's locations of where it has its plants. So this dummy variable non-attainment turns on to be equal to 1 if that county is designated non-attainment as of year T. Okay? So you can basically imagine this variable as a measure of regulatory stringency faced by the firm. They definitely do not emit ozone directly. So I actually label them into either VOCs, volatile organic compounds, or NOx, nitrogen oxides. So any of those two types of chemicals will be classified as ozone precursor. And also, I consider ground level ozone. So this is not ozone in the atmosphere. This is kind of, local pollution. Yeah. Yes. So you can basically consider a multi-plant firm, so a firm that has a lot of its plants, and all these plants are located in non-attainment counties, and they all emit a lot of ozone. That's going to lead to a higher measure of non-attainment exposure. All right. So onto the regression discontinuity. So again, the problem is that there could be endogenous selection of where the firm locates its plants. Counties could simply be non-compliant because they tend to have higher economic activity on average. So what I basically do is the intuition here is if the underlying concentration levels, which the EPA calls them design values, it's just a fancy name for the concentration level. And it's basically calculated as kind of like a rolling average. So just imagine it's like a concentration level. If that concentration level in any particular year is so far above the threshold, then with almost certainty, no matter how that concentration level changes, the county is probably going to remain in non-compliant, right? It's very unlikely they're going to suddenly reduce pollution in the next year. Similarly, if the concentration levels are so far below the threshold, similar logic, then it's very unlikely for the county to suddenly go above the threshold and become non-compliant. But you have this kind of optimal bandwidth or this narrow window around the kind of threshold where concentration levels are quasi-exogenous in a sense that it's kind of determined by the weather, right? How the wind blows, the temperature, conditions. 1 year it might be slightly above, the next year might be slightly below. It's basically random. And I'm basically going to exploit kind of this type of variation to do that decomposition. So that's exactly what I do. So this non-attainment exposure variable is going to be decomposed into this unexpected component. So this dummy variable equals to 1 if the county is basically located in this unpredictable region. And this anticipated non-attainment dummy variable is going to be equal to 1 if the county is located far to the right of that, where it's basically predicted to be non-attainment. So I'm basically going to use these two variables to in the stacked or staggered DID to look at the effects, whether it's driven by the endogenous or the exogenous component. Okay. In terms of the empirical specification across kind of the series of projects, it's going to be standard, staggered, or stacked DID, where the outcome variable, I'm going to define that very soon. The key independent variable here is going to be non-attainment exposure. I'm also going to use its two components, right? And it's continuous treatment, right? So it's not a dummy variable, it's continuous. So if this takes on a value of 0, those are basically the control firm years. If in a particular year, the firm operates an ozone-emitting plant in a non-attainment county, then this variable is going to switch from 0 to some positive number, right? And that positive number is going to represent the intensity of the treatment. The greater the value, essentially, you can imagine the more regulatory stringency the firm faces. And for firms that don't operate any plants, it's going to be these never treated units, always control. Okay, so onto the kind of applications. So the first set of results are going to be on firms' corporate governance, right? So the idea here is that when this regulatory shock hits, it's going to impose persistent operating costs on the firm, right, due to the compliance costs. And we know from traditional corporate finance theories that shareholders are risk averse, right? They don't want to, they're scared of bankruptcy risk. And basically the shock, because it lowers future expected cash flows, it's going to decrease the expected payoffs from risky investment, right? So an investment that potentially seemed optimal without the adverse shock is now seen to be more risky because of those persistent shocks.
Could you give me a sense of the size of the fine associated for being non-compliant? Like just how much does this eat into the profitability, or how does it compare to other fines or shocks that the company might experience?
Yeah, I have a slide on that coming up. So it's actually, so this is actually the hard part. So we actually, even though it's quite costly, it's very hard to get data on compliance costs, especially at the facility level. It's just super, I'm actually not aware of any data set. Previous studies have used like surveys and stuff, but it was quite a long time ago, 2000, 2005. But it's hard to get direct compliance cost numbers. Yeah. So the basic idea here is that while shareholders want to prevent manager overinvestment. So what they want to do is, if the board acts in the best interest of the shareholders, they want to reduce risk-taking incentives, right? So I'm going to measure risk-taking incentives by Vega, which is standard in the corporate finance literature. It's basically the change in the wealth of the stock option holdings of the CEO in response to a 1% change in the underlying standard deviation of the stock returns, right? So a higher measure of Vega represents more risk-taking incentives in the compensation structure of the CEO. And what you can see is that when a firm is hit with this non-attainment exposure shock, it leads to a decrease in Vega. And it's completely driven by the unexpected or the exogenous component, and there's no effect on the endogenous component. So here's another set of figures that looks at kind of more cross-sectional variation here. And I also document something known as gambling for resurrection. This is also a standard agency problem in the corporate finance literature, where if a firm is kind of close or at the boundary of financial distress, actually it could be good for shareholders to take on more risk and not less risk, because any payoff that succeeds from the risky investment first goes to the shareholders. And if it fails, well, so be it. The firm is close to distress anyway, right? So if the firm is close to financial distress, actually that average effect that you just saw in the previous slide could be attenuated, or the sign may even reverse. It may even induce more risk taking. And that's exactly what we see. So across 4 different measures of financial constraints, measures in the literature, the y-axis here is the marginal effect of unexpected non-attainment exposure on the outcome variable Vega. And you can see the marginal effect is always upward sloping, right? So if you look at if it's kind of if the firm is not very financially constrained, the effect is negative, right? That's in the previous slide. But if the firm is very financially constrained, the effect is less negative. It's attenuated. And sometimes at the high end, the sign even reverses from negative to positive, right? So this is standard kind of gambling for resurrection behavior. Okay. Another setting, what about audit fees? So this is joint work with Eddie, where we look at environmental regulations, and they could have an effect on 2 things. One, client risk, right? It's gonna because of these compliance costs, the firm may be subject to non-compliance. So it's going to increase the client's risk. It's also going to increase the complexity of the audit, right? The auditors may have to hire specialized or talented labor to navigate the kind of internal complexities of these regulations, to assess material weaknesses in internal reporting. And all of this combined is basically going to lead to a greater effort on part of the auditors to assess the internal controls, whether there are any material weaknesses, and whether there are any compliance issues as well. And we know from the audit literature that when there is an increase in client risk and increase in effort, it's going to lead to a fee premium that's charged upon these firms due to 2 things. One, litigation risk, right? If the audit fails, the auditor is going to be subject to litigation risk, and it's also going to damage their reputation. So they're going to charge a higher fee premium. So the prediction is that increases in non-attainment exposure, it's going to increase the audit fees charged to these firms. And that's what we see. So if you look at the coefficients here, when the outcome variable is audit fees, you see the coefficient is positive, and again, it's completely driven by the exogenous component. Right? Most of all these results here are kind of due to the latter, right? It's kind of this something that the firm can't control due to random variations in the weather, etc. That where they're located is suddenly now designated as non-attainment. It's really outside their control. That's good for identification purposes because of exogeneity, right? To the second point, we could capture that. The only problem is that, it's very hard for firms to influence non-attainment exposure, right? So because the facility emissions are very small relative to non-stationary emissions from motor vehicles and other things, so you can basically kind of consider as non-attainment exposure to be this exogenous measure of regulatory exposure. It's not something that the firm themselves are doing to increase this. For example, in this analysis and in a previous one, exactly as you mentioned, not the biggest polluter, but I do have, for example, a double interaction here with, for example, whether the firm operates plants that has a high priority violation, so they kind of violated a provision of the non-attainment designation, whether they have pending enforcement cases against them, and other kind of cross-sectional analysis where, for example, if the firm operates very young plants are very subject to non-attainment designations because they don't have this grandfathering effect. A lot of older firms, they kind of have machinery in place, right? So unless they really expand operations, they're kind of shielded from the regulations at first. And also distance to air monitors matters as well. So if the firm has plants that's located very close to an air monitor, the intensity of treatment is going to be greater for those firms because state regulators tend to focus on areas close to the air monitors. And they have incentives to do that because they want to, because it's picked up by the air monitors. So yeah, I do have cross-sectional tests on that. And the effects are basically as you expect. They will be more pronounced for high intensity of treatment. Yeah. The application actually doesn't tend to happen for ozone precursors for several reasons. And there's literature in environmental economics that studies this. So for example, a lot of these facilities have specialized labor, and labor mobility is very hard. So Reed Walker at Berkeley showed that, when a non-attainment shock hits, labor moves, but it moves within county. It doesn't move across county, right? So a lot of specialized labor is kind of concentrated. There's also supply chains that's hard to replicate if you just move to a new county. That's documented by Becker and Henderson. And also there's, it's not a free lunch because even in attainment counties may not be subject to ozone nags, but there are other regulations. For example, HAPs, the hazardous pollutant. So a lot of these chemicals that they emit, they may be ozone precursors, but they can also be classified as hazardous chemicals. And there's other regulations that regulate those in which attainment counties could be subject to those regulations. So it's not a free lunch, and so you don't actually see significant reallocation that happen. Yeah. Okay, so kind of this back to this auditor, and if you look at the mechanism, that's exactly what we see, right? So kind of days to sign here, this is a continuous variable. It's the difference between the end of the fiscal year of the firm and the date at which the auditor signs off on the audit opinion. So a greater value of this means that the auditor exerts more effort. This is standard in the audit literature, and you can see, so kind of audit effort goes up. Going concern is a variable equal to 1 if the auditor issues a going concern modified opinion in the auditor report. It's a measure of the risk opinion of the firm, that the probability of that goes up. Material weakness is a dummy variable equal to 1 if the SOX internal control internal control opinion has a material weakness. And again, you can see that goes up as well, right? So this is kind of increase in the client risk, increase in the audited effort, and that overall leads to an increase in the audit fees. Okay. All right, another setting, corporate philanthropy. So in the philanthropy literature, there's always this problem of endogeneity, right? And so the question there is, what determines firms' giving, right? And examining determinants is very important, but there's always this underlying problem because the firm's decision to give and whatever variable you look at right? Incentives or CEOs incentives, or in this case, incentives to pollute are endogenous, determined, right? But the regression discontinuity in the setting is super nice to kind of introduce this exogenous variation. So the idea here is basically firms that pollute more also tend to donate more because of kind of this insurance mechanism, right? It's like if I know that I have this local pollution, it's going to introduce negative externalities to the local community. I'm going to also give more because potentially that could offset the future cost. And if you look at, for example, the biggest polluters in the US, Chevron, ExxonMobil, they're actually one of the biggest donors to green nonprofits in the local community, right? So I'm going to study that question basically. And what I'm going to basically do is look at close attainment counties. So these are counties that are slightly above the threshold. So here I flip the sign, right? So usually slightly above means it's non-compliant, but just so the figure is presented nicely, if it's slightly above the threshold, it's in compliance. If the county is in compliance, firms have more incentives to pollute there because they don't have any restrictions of pollution. If it's slightly below the threshold, it's close non-attainment. And because there's emission limits, the firm has less incentives to pollute. And so what I'm basically going to document is kind of represented by the slogan: every emission you create, every dollar you donate to the local community in that area. So this is very granular. So this is not firm year level. This y-axis here represents the amount of donations at the county firm year level, right? So it's the amount of donations made by the firm's corporate foundation to local nonprofits where the firm operates its polluting plants. Okay? And it's very hard to get granular exogenous variation at the local level. And what you can see here is that the donation is kind of a continuous function of the underlying concentration levels everywhere except at the next threshold. Right? You can see that if you jump from close non-attainment to close attainment, in other words, going from low incentives to pollute to high incentives to pollute, the firm donates more to the local nonprofits. If this is really a story about kind of offsetting potential adverse effects of the local pollution, then the firm should direct its donations to nonprofits that actually address pollution, right? It's kind of useless if you donate to like religion, sports, or arts, which is kind of unrelated to pollution. And we don't see that. So if you kind of decompose those donations across the nonprofit categories, what you'll find is that they donate more to health nonprofits, social and human services, community development, environment, which is all kind of related to this negative externalities of local pollution. I have a lot more tests in this paper that looks at other incentives, but kind of that's the general story. Implicit relational contract, right? So it's kind of like it's almost like a price paid for their pollution. So you can just imagine like a normal insurance context, right? Where you pay an actual price, and if there's a negative outcome in the future, it's going to offset that negative outcome. Here, it's basically you're paying a price. What's the price? The price is basically the amount of donations. And the CSR literature shows that. So this is looking at kind of the first step. The CSR literature has always looked at the effects of, for example, donations or some other ESG, and it has positive. Well, there's arguments there, but some studies show that it improves shareholder value, firm value, etc. What I look at is kind of the pre, right? What drives them to do that? And the story here is that they kind of pay this price represented by the amount of donations, and from the CSR literature, that's going to offset potentially the negative effects of their local pollution in the future. It's actually motivated by a paper by Marion Bertrand in the AER that shows that indeed these firms are quite strategic in their donations. It's a quid pro quo where they donate to the politicians in the same constituencies as where the firm is located. And they also donate to nonprofits. And what you'll find is that these nonprofits tend to not vote, but tend to be very vocal on issues that's beneficial to the firm later on. So there is indeed that strategic effect there. But here, what I really want to document is kind of this more kind of insurance or relational contracting, the incentives behind why they do that. And one of the incentives is, well, we're going to pollute more. So, okay, let's make ourselves appear, nice to the community, basically. Yeah. Maybe they'll forgive us if we do something bad. Yeah. Okay. Another setting. So this is going to be on firms' informational disclosure. And so I'm going to look at management earnings guidance. And the story here is that, this negative kind of adverse shock introduced by non-attainment designations is going to increase the firm's regulatory uncertainty, firm-specific uncertainty. And even though kind of outsiders know this is a negative cash flow shock, it's very hard for them to quantify this, right? They don't really have any hard information, but managers have private information. They know how it's going to impact the firm's operating costs, right? And so they could have this information. And we know from the management guidance literature that there's this asymmetry in bad news and good news. So bad news and good news are both informative, usually, but the magnitude of bad news is usually much greater, right? And the idea is that bad news seems to be more credible. And what I'm going to document is this conditional effect, where bad news is going to be even more credible when a non-attainment shock hits, because kind of the firm is already in this adverse kind of environment, and then the firm issues bad news on top of that, then it's kind of more believable because it's kind of this credible revelation of this downside risk playing out. And it's going to amplify its informativeness because it's going to be perceived as more credible by the capital market. Whereas if the firm is then suddenly issuing good news when they're hit with this adverse shock, it's seen as less credible because potentially it's kind of strategic, right? The firm kind of wants to say, hey, we're actually not doing that bad, kind of believe us. And so it's going to be discounted. That's kind of the intuition, right? So I'm going to measure management guidance news, standard in the literature. It's just a deviation from the consensus forecast. So positive deviations are going to be good news. Negative deviations are going to be bad news. So what I'm going to do, the outcome variable here is going to be the abnormal stock returns of the focal firm around the date of the management guidance issuance. And what you will find, whether you look at good news or bad news, if you just look at the coefficient of manager news, this is consistent with the management guidance literature, right? Both are informative, but the coefficient on bad news is much larger than that of good news. So this is just documenting the kind of what we know already. What's new here is the conditional effect, the incremental informativeness on top of the standard effect, which is represented by this interaction terms. Right? And what you'll find is that if you split the sample into good news and bad news, there's this asymmetry that occurs. If you look at the bad news component, right, this coefficient here, bad news is now even more informative, right, because of that kind of increase in credibility. So if the firm is, very subject to non-attainment exposure, and the manager is given more bad news. So here, if this value increases, it's less bad news, right? Because bad news is already negative, right? So if this value is lower than bad news, then the stock returns is more negative, right? So it's in the same direction. Whereas if you look at good news, now conditional on non-attainment exposure, good news is less informative. So there's a discounting that occurs. And so this is interesting in and of itself to document that these regulations have real effects on how the stock market perceives the informativeness of management disclosures, right? Okay, so that's kind of those that uses kind of the staggered DID. I'm then going to exploit another way that counties can be designated as non-attainment. I'm going to do event studies and stack the DID. So this is kind of what Max kind of hinted at earlier, where we have this threshold, and the threshold is going to change, and it's changed 4 times in history. So these are represented by these 4 Ps, right? And basically what happened is that the EPA lowered the threshold. So you can imagine a county where its concentration levels don't change. It's like completely constant, but then suddenly the EPA lowered the threshold. And now, even though the county didn't do anything, it's suddenly designated as non-attainment, right? Because the threshold now is below the county's pollution levels, concentration levels, and the county is designated as non-attainment. This happened 4 times, and you can see each time it happened, there is a huge spike in the number of non-attainment counties that was introduced. And this is very exogenous, because this is just due to purely exogenous changes in the EPA's threshold. Now, you might say, wouldn't investors know about this beforehand? Like, shouldn't this be announced? Indeed, they are announced. But, so for example, if you look at the June 15, 2004 change in the threshold, this was announced in 1998, actually. But the problem is that usually why it took so long for it to be effectively implemented was each time the EPA proposes a change in a threshold, there's a lot of court cases. There are like 10 to 20 court cases, lobbying, firms don't want the threshold to change because, they have to, do a lot of changes themselves. And so it's very uncertain. When it's announced, you don't actually know whether it's really going to be enforced or not. And there are cases where the EPA did propose a lowering of the threshold, but it never ended up passing through. The courts stopped it. So that's why I look at effective dates and not the announcement dates, because the effective date is when the uncertainty is actually resolved and you know with certainty that the regulation is actually going to be effective and implemented, right? These are just counties themselves. Obviously when they're hit with non-payment, so this is a net effect, right? So there's more counties going into, back into attainment versus non-attainment. So it doesn't mean that there's no counties going into non-attainment here. It's just that on average, net, there's more. And that makes sense because counties have incentives to quickly get back into attainment, right? They don't want to stay in non-attainment. But there is still non-attainment activity going on here. Yeah, it's just that the net effect is huge whenever this policy change happens. Yeah. Called the lowest available emissions restriction is that you have to install the technology like scrubbers or stack chimneys that reduces emissions to a specified level. It depends on how much you emit at the facility. If you're like a really big facility, you got to get to like a certain emission limit. And this is regardless of economic cost. The EPA is going to impose this and they don't care about that. Whereas for attainment counties, there are still limits, but it's called the RACT, the reasonable control technology. So the EPA will take into consideration economic costs. If it's so expensive for you that you're going to fail, then they probably won't impose it on you. But in non-attainment counties, so that's the most direct. But there's also, raw materials. They have to change the way the raw material, because these are ozone precursors, right? So some chemicals, if they're released and they interact with the sunlight, it's going to release more ozone. So they have to change the way that they introduce chemicals as well. But that's kind of the next study, is that I'm going to look at the shareholder wealth effects. And I was very surprised that no papers actually looked at this. This is kind of from finance. It's like the first thing I would look at. And it kind of makes sense because there's kind of two strands of literature here. The environmental economics literature just looks at the direct effects of these regulations on health, etc. And they mainly emphasize the cost channel, the compliance cost channel, right? And the story here is very simple. It's when you kind of get hit with these operating costs, it's going to increase your compliance and abatement costs. It's going to increase the operating costs, eat into your profits. It's going to lower the firm's bottom line. Okay? But the IO literature and the strategy literature looks at this from the kind of competitive advantage approach. And the idea here is that, well, if some of these regulations is going to drive out the less efficient firms, it's going to prevent new entrants from entering. It's going to be more expensive. There's barriers to entry. And it's going to shift the rents towards the incumbents, the firms that basically survive. And it could stimulate innovation. This is a different question, but there's arguments for that as well. And so really the kind of effect on firm values is going to be non-linear. And it's going to depend on how much competitive advantage and the compliance costs are going to trade off against each other. And I'm basically going to document this kind of inverted U-shape, this non-linear trade-off between competitive advantages and compliance costs. Right? So first what I do is just very standard, just a event study around those 4 peaks. So here I'm only looking at those 4 peaks. And I'm basically going to look at firms that have some exposure to non-attainment, so that's represented by the solid curve, and firms that have no exposure, 0 exposure to non-attainment exposure. And what was really surprising first when I did this is that the firms that have exposure benefit actually. The stock market interprets this as a good signal. Now, from the environmental economics literature, this is kind of contradictory, right? You might think, well, the increase in compliance costs, it's a bad thing for firms. Why the stock market's reacting positively? But this is the average effect, right? I'm not introducing any non-linearity here. It's just the average effect. But if you have a look at the non-linear effect here, so here what I do is I do cross-sectional regressions. The outcome variable is going to be the CAR from -5 days to 5 days around that effective date. The y-axis is going to be, the x-axis is going to be unexpected non-attainment exposure and its square term. So I also include the square term, the quadratic terms in the regression. And then you can basically plot how firm value changes as non-attainment exposure changes. And then you can basically see this inverted U shape where having some exposure to regulation is good, right? Like the compliance costs are not that high. You benefit from the competitive advantages. Some firms are driven out. You have a bigger portion of the pie. Shareholder value increases, firm value increases. But if you're so exposed to non-attainment exposure, becomes detrimental, right? Because now all of your efforts are going to compliance costs. Yes, you still get that competitive advantage, but the compliance costs eat too much into it, and you see this overall decrease in shareholder value. We actually see this if you look at the accounting performance. So this is short. I do in a paper mechanism test, like at competition measures, concentration of sales across counties. It's kind of all consistent. But if you also compare those short-term reactions with more long-term measures of accounting performance, so now I extend the window from -4 years to 4 years after that policy change, and look at accounting outcome variables like revenue over assets, operating income over assets, gross profit margin, which is revenue minus COGS divided by revenues, CapEx over assets, COGS over assets. And what you'll find is this contrasting picture, but it's consistent with the short-term reaction. So you can see that if you don't have, so this is the marginal effect, right? So it's the marginal effect of non-attainment exposure on the outcome variable here. So for example, for the income measures, if you don't have too much exposure to non-attainment designations, it's good, right? You see this positive effect on revenue. If you have too much exposure to non-attainment designations, then it eats into your income, right? You see the opposite reaction for costs, right? So for CapEx, if you don't have too much exposure, not too much compliance costs, it's okay, right? Like it's negative, but then it kind of goes up. It now becomes positive. Same with COGS as well, right? So this short-term market reaction seems to be efficient in the sense that it does reflect the long-term effects on the firm's accounting performance. Okay. All right, the last setting I'm going to have a look at is investors' portfolio allocation. How do mutual funds react to this, right? If these potentially non-financial information from environmental regulations have cash flow implications and also affects the firm fundamentals, surely mutual funds could potentially trade on this and earn risk-adjusted returns, right? Being kind of natural arbitrages themselves. So what I basically do is I look at, first I should mention, this basically tests Pasteur et al.'s kind of framework, right? Their framework basically says that, okay, if a regulatory shock hits, environmental regulatory shock hits, the way that investors or institutional investors react should depend on the correlation between the cash flows of that shock and the regulatory shock, right? So if the cash flows covary positively, it's better performance, then those shares should be actively bought or overweighted, right? If it performs poorly, if there's a negative correlation, then those shares should be actively sold, right? So I'm going to basically test this. I'm going to use equity mutual funds, right? And so I'm going to exclude like balance, index, etc. I'm going to use very standard measure in the literature. So here it's basically the change in the portfolio weights of those shares, but I'm going to keep prices constant, right? So this is not a mechanical effect that's due to changes in prices of these stocks. It's due to the changes in the actual trading of the mutual funds, updating or rebalancing their portfolios. There's going to be kind of this change in the weights. And if you use a stacked DID, right? So here, again, I'm only focusing on those 4 peaks. I'm going to look at quarters, and mutual funds data is at the quarterly level. I'm going to look at 4 quarters before to 4 quarters after the shock, use a stacked DID. The outcome variable is going to be the active change in the portfolio weights. What you'll find across all the columns is that when the firm is hit with this non-attainment shock, the mutual fund underweights, right, these firms due to these negative cash flow shocks. And again, it's kind of completely due to these unexpected or the exogenous component. No effects at all for the endogenous component. It's already kind of basically priced in, right? The last kind of analysis here is that, okay, so mutual funds are changing the way that they rebalance their portfolios. Is it actually a profitable strategy, right? Is there a positive alpha that you can kind of earn from this? I show that there is. So the idea is, this is standard in the literature. I look at the DGTW adjusted CARs. It's basically you risk adjusted return. You're just subtracting it from like a benchmark based on the stocks in the mutual funds portfolio. So basically for each quarter of that shock, the event quarter, I'm going to split the sample into low exposure and high exposure. This is based on the median value of non-attainment exposure as of that policy change. Then I'm going to then sort those into terciles based on the amount of change in the portfolio weights of mutual funds that hold that stock, right? So tercile 1 is the most underweighted. So these presumably perform the worst. And tercile 3 is the most overweight or the least underweighted, presumably performing better, right? And then I'm going to have a look at the kind of spread between these two portfolios, and the spread should be positive, right? That's exactly what we find. So I'm going to look at 1 year before the policy change up to 3 years after the policy change. The terciles are going to be the lowest, so the most underweighted to the least underweighted. If you take the difference between this portfolio and this portfolio, you get a negative spread. Positive if you take the other position, right? So if you're long portfolio 3, short portfolio 1, you're going to get a positive value across here. So you can see there's no effect before the policy change, but after it, right, there's a negative spread, or the most underweighted underperforms the most overweighted. There's no effect for the endogenous component as expected. If you have a look at the low non-attainment exposure, right? So here, these are the stocks that don't have too much exposure to non-attainment. There's no effects across either. That's expected, right? Because if the cash flows don't really vary in response to the shock, because they're not very exposed to it, then this underweighting and overweighting shouldn't really have any spread. And then if you take the difference in difference between those two, so controlling for trends, etc., you can still see that the tercile 1 underperforms tercile 3. Right? So this is kind of a positive alpha that the fund can earn if they implement, if they trade on this non-financial information. All right, so let me conclude. So in the series of work, I've kind of introduced this exogenous setting, right? And I've kind of created this firm year measure of environmental regulatory stringency. It's based on non-attainment designations from the National Ambient Air Quality Standards. And the key feature of this is that it has binding compliance costs at the facility level. And what I show is that regulations could have unintended consequences, real effects, right? That is beyond just the direct health effects and also the compliance costs implemented due to these regulations. And so I kind of show these real effects. They have financial and material effects across a range of different settings, right? Across corporate governance, audit fee pricing, corporate philanthropy, management information disclosure, shareholder value, and how mutual funds adjust their portfolio holdings. And I think there's a lot more work that can be done in this area. You know, I kind of alluded to this earlier. You could apply this framework to study whether innovation is halted or is innovation driven upwards. It's also interesting to look at capital reallocation, right? Because not all firms could suffer from this, right? Because sometimes the regulation introduces competitive effects, and so shareholders or investors may reallocate their capital depending on how they view these, competitive effects versus compliance costs. Effects across labor markets, how does it affect human capital? And lastly, it'll be very interesting to apply similar concepts across different regulatory settings, right, to study this important question of regulatory risk exposure. Thank you very much, and open to any questions. Thanks.